Welcome back to Investing Talk Podcast.
Today, we are counting down the top 5 stocks to buy right now based on our latest research.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, Alex, let's start the countdown. What's the first company on our list?
First up is Aquestive Therapeutics. The reason it's standing out is really its pipeline of regulatory catalysts. That and its proprietary drug delivery technology.
Yeah.
We gave this one a pretty bullish rating, actually, 8.5 out of 10.
Right, 8.5. And that high score is pretty much all riding on one key thing, isn't it? The upcoming FDA decision.
Exactly. For their lead product, Libervant. That's the diazepam film.
And we're expecting, what, an update around December 2025? That's the make or break moment?
It absolutely is. For any biotech, that regulatory step is just huge. But this treatment, it's aimed at a pretty significant unmet need in managing CNS disorders, central nervous system disorders.
Okay, so the catalyst is clear, the FDA date. But the technology. You mentioned this farm film. Why is that such an advantage? A film seems, simple.
It sounds simple, but apparently it's quite revolutionary because of how the drug gets absorbed. See, for conditions where you need a really rapid intervention, like, say, acute epileptic seizures, which Libervant targets, you need speed. You need reliability.
Okay, faster than pills, I assume.
Way faster. And, the alternatives are often nasal sprays or even rectal gels. Not ideal. This farm film, it's an oral dissolving film. So it allows for really rapid absorption straight into the bloodstream, bypasses the whole digestive system.
Which makes it quicker, easier to use outside a hospital, and less invasive, definitely.
Exactly. So it really carves out a niche in that emergency treatment space.
Interesting. That makes sense technologically. But let's talk valuation, because you mentioned the analysts.
Yeah, that's where it gets interesting, or maybe a bit scary. 7 analysts are calling it a strong buy.
7, okay.
And the price targets go up to $10.71. That's, a potential 72% upside from here?
72%. Wow.
But isn't all that optimism, isn't it entirely built on that one FDA date? If that decision gets delayed, or worse, it's negative,
And yes.
that valuation, that potential 72% gain, just evaporates, right? Poof.
You're absolutely right to point that out. It's a classic binary event. The risk profile here is definitely elevated leading into December, no question.
Okay.
But that analyst consensus, it reflects, the strength of the clinical data they've shown so far and the utility of the platform tech itself. It's sort of priced for success because the market sees the risk of an outright rejection as relatively low based on, the back and forth they've had with the agency already.
So it's a calculated gamble, not just pure hope.
Exactly. It's based on the data. High risk, definitely, but potentially very high reward. If they get the green light, it could re-rate significantly.
Okay. Aquestive Therapeutics, a high-stakes catalyst play.
Interesting. Moving on, my pick for the next one is B2 Gold. We're shifting gears completely here. Away from biotech risk.
Right.
And into operational resilience. Strong financial execution. We're talking about the gold sector now.
B2 Gold. Okay. I like this shift. They've been pretty solid, haven't they?
Solid is an understatement. They're delivering results that kind of insulate them from the market noise. Look at their Q2 2025 performance. Revenue surged. Get this, 41% year over year.
41%. Wow. That's not just riding the gold price then. That's execution.
That's strong management and serious production output. And speaking of production...
Yeah, what are the numbers looking like?
They pumped out 254,369 ounces in Q3 2025. That's strong enough that management felt confident reaffirming their annual guidance.
Even with that operational noise they had at the Goose Mine recently.
Exactly. They managed through it. Now, what those production numbers, combined with their costs, really mean for you, the investor.
Right. Break down the costs. That's key in mining.
It's all about efficiency. Their cash operating costs were reported at $780 per ounce.
$780. That sounds pretty low.
It's really low. That puts them comfortably in the top tier globally, top quartile easily.
Yeah.
You've got competitors with costs over $1,000, sometimes $1,200 an ounce.
So B2 Gold can stay profitable even if gold prices take a bit of a dive.
Precisely. They can thrive when others are just struggling to break even. That's the resilience we're talking about, downside protection.
And that stability, that must flow through to shareholders too, right? Dividends?
Absolutely. It allows them to commit to shareholder returns. They're keeping their dividends steady, 2 cents per share declared for Q4 2025.
That's great to see.
In the gold space, being able to consistently return capital while you're managing big projects and keeping costs down, that's a huge differentiator. It shows real financial discipline.
Okay, BD Gold stability, low costs, dividends, a different kind of opportunity. Now, my turn again.
Your turn. Where are we going next?
Let's put on our metaphorical hard hats and dive into the microcap world.
Yeah.
High risk, maybe, but potentially explosive payoff. Let's talk about BioKey International.
BioKey. Yeah, this is a really interesting one. A niche security play, right? Identity management.
Exactly. Huge growth area.
Yeah.
And they earned an 8 out of 10 bullish rating from us, mostly because the growth numbers are just, well, they're kind of nuts for a company this size.
What are we talking about?
Q2 2025 revenue up 49% year over year, almost 50%. It shows there's rapidly growing demand for their biometric stuff globally.
Nearly 50% growth.
Okay.
But with microcaps, sometimes the quality of that growth matters. Are these solid contracts?
That's the thing. The quality seems really high. They just announced a big defense sector deployment in the Middle East.
Defense sector. That's a major validation if you're trusted by defense, especially in that region.
Right. It speaks volumes about the security of their platform. Huge third-party validation.
Definitely. And are they expanding elsewhere?
They are. They're broadening their footprint internationally. They just secured new partnerships for distribution in Europe, specifically with a company called IT2 Trust in Scandinavia.
Okay, so they're scaling internationally. It's not just one region. That suggests the growth might be sustainable.
It looks like it. They seem to be executing a clear strategy to scale up.
Okay, growth looks good, contract quality looks good, but it's a microcap. My usual worry kicks in. Liquidity.
Ah, yes. The elephant in the room for small stocks.
Can you actually get in and out of this thing easily? Even with good news, if you're a larger investor, moving the price can be a real issue, can't it?
It's a totally valid concern, and yet liquidity is always a primary risk here. Always.
So how are they mitigating that?
Well, one positive development is they recently secured some fresh capital, came from warrant exercises.
Okay, so cash injection.
Right. That influx improves their cash position, their liquidity on the balance sheet. Doesn't solve the market depth issue entirely, of course, but it does reduce that immediate financial risk that often plagues these smaller growth companies.
Good point. Less balance sheet stress. And any near-term catalysts to watch?
Definitely. Keep an eye on their Q3 2025 earnings report. That's expected around November 13th. The expectation is for strong sequential improvement, so that could be a big catalyst.
Okay, BioKey. High growth, key contracts, but watch that liquidity and the upcoming earnings. Got it. Let's shift gears again, big time.
Where to now?
From niche biometrics to a global financial giant, one that's been, frankly, crushing its European peers. Let's look at ING Group NV.
ING, the Dutch bank.
That's the one. And this one gets our highest rating on the list today, a strong 9 out of 10.
9 out of 10. Okay, what makes it stand out so much?
It's just the picture of financial stability combined with a serious commitment to shareholders. They're a dominant force in European banking, really. Their net margin is exceptional, nearly 24.5%.
24.5% margin. That's huge for a bank.
It is, but the really crucial figure, the one that tells you about their rock-solid foundation, is their core capital strength. You look at the CET1 ratio.
Okay, let's break that down. CET1 ratio. What is that exactly, and why is their number important for, someone listening?
Right. Think of CET1, Common Equity Tier 1. It's like their ultimate safety cushion, their emergency fund. It's the highest quality capital banks hold to absorb unexpected losses.
Okay, the buffer.
Exactly. Now, regulators set minimums they have to hold, usually around, say, 11% these days. ING's ratio, it's sitting at 13.4%.
13.4, so well above the requirement.
Well above. It means they are exceptionally safe, incredibly stable, and crucially, they have a ton of excess capital just sitting there that isn't needed for regulatory purposes.
And because they're so safe and have all this extra cash, they're giving it back to the owners, the shareholders.
Precisely. That's the payoff for stability. They just finished a massive 2 billion share buyback program.
2 billion euros.
Yeah. And literally right after that finished, they launched another 1.6 billion distribution program.
Wow. So that's, 3.6 billion euros combined? Returned to shareholders pretty quickly.
You got it. That 3.6 billion commitment in a fairly short window just screams confidence. Confidence in their earnings power, their ability to generate cash far beyond what they need to run the bank.
And the markets notice this stability in these returns, I assume.
Oh, yeah. The share price reflects it. It surged 45% year to date.
45%. Nice.
Yeah, that shows strong momentum, both technical and fundamental. They're also benefiting from, interest rates stabilizing in Europe, which generally helps bank margins.
Makes sense.
Okay.
So next catalyst for ING.
Keep an eye on their Q4 2025 earnings release. That should be sometime in January 2026. That'll be the next key checkpoint.
Okay, ING Group. Stability, strong returns, solid momentum. Our top pick at 910 now. We have one more.
One more, and for this final one, we have to talk about something, well, completely different again. A real high volatility name, Beyond Meat.
Beyond Meat. Okay, definitely different.
Yeah, and let's be crystal clear up front. This is not a fundamental investment pick based on, operational strength like B2 Gold or ING.
Right.
This is purely for the investor, maybe trader is a better word, seeking short-term opportunities driven by market technicals. It gets a 7 out of 10 bullish rating, but that's despite some monumental underlying risks.
Okay, really important to stress that. Speculative play. Because the fundamentals, honestly, they look pretty challenging, don't they? Q2 sales were down sharply.
Very sharply.
And they had that massive shareholder dilution from the debt restructuring. Can you just quickly explain what that means for someone holding the stock? Over 300% dilution?
Mm-hmm.
What's the impact?
Yeah, it's brutal. Imagine you own a slice of pizza, right? That's your share of the company.
Okay.
Now, to raise cash or fix its debt, the company suddenly decides to cut that same pizza into 4 times as many slices. Your original slice is now tiny. It represents a much smaller piece of the whole pizza. That's dilution. There are way more shares out there, so each existing share represents a smaller claim on the company's equity and future earnings. It hammers the value.
Which is why you said it's not a long-term investment based on fundamentals.
Absolutely not. The dilution makes that very difficult.
Why on earth is it on our list then? If the fundamentals are tough and dilution is high.
Because of market psychology, because of extreme volatility. You just have to look back at what happened in October 2025.
Right, that crazy rally. Shares surged. What was it? Over 1,000% in just 6 days.
Over 1,000%. It sounds completely impossible based on the business itself.
So what drove that?
Purely a technical short squeeze. Classic case.
Explain that quickly.
Yeah.
Short squeeze.
Okay, so you have a stop with really high short interest. That means lots of traders are betting against the stock, borrowing shares and selling them, hoping to buy them back cheaper later.
Okay, betting the price will fall.
Right. Now, if some unexpected buying pressure comes in, maybe good news, maybe just momentum chasing the price starts to tick up, those short sellers start losing money.
They need to cut their losses.
Exactly. They rush to buy back shares to close out their bets. But all that buying just pushes the price up even faster. It creates this intense feedback loop.
And with Beyond Meat, the number of shares actually available to trade, the float, is relatively small, right?
Very small, which means that buying pressure gets amplified massively. A little buying can move the price a lot, triggering more short covering, and boom, you get that 1,000% spike.
So this pick is basically a vehicle for trading that potential volatility, banking on high short interest, potentially triggering another squeeze.
That's essentially it. Now, the company is trying to pivot. They're talking about new products from their Beyond test kitchen, hoping maybe holiday season spending gives them a small boost.
Trying to stabilize sales, yeah.
Right. But for a short-term trader, the real focus isn't the test kitchen, it's the next earnings report, which should be in early December.
Make or break again, but in a different way.
Exactly. That report will either confirm that sales are still collapsing, which could trigger a big sell-off, or maybe it shows just enough stabilization, just a tiny flicker of hope that could fuel another short-term rally, maybe squeeze shorts again.
High stakes. Very high stakes. Requires perfect timing.
Absolutely. This is a pure volatility trade, not for the faint of heart, and definitely not a core holding.
Okay, Beyond Meat. The speculative wildcard.
That's a good way to put it.
So to recap, our 5 stocks to watch are Aquestive Therapeutics, the biotech catalyst play, B2 Gold, our resilient gold miner, BioKey International, the explosive microcap growth stock, ING Group NV, the financially stable European banking giant, and finally Beyond Meat, the pure speculation technical trade.
A solid list covering very different risk profiles, wouldn't you say? As always, do your own research before making any investment decisions. These are just ideas based on our analysis.
Absolutely. Do your homework.
But maybe one final thought to leave you with. When you look at a stock like Beyond Meat versus a stock like ING Group, the difference isn't just the sector or the size, it's really about the market's current mindset, isn't it?
Interesting point.
Are you buying stability, proven cash flow, shareholder returns like with ING, or are you buying extreme volatility, hoping to catch a wave, maybe banking on a short squeeze like with Beyond Meat? Understanding which game you're actually playing with each investment, that might be the most important piece of homework you can do right now. Thanks for tuning in.